A very good afternoon. You're watching the newsroom right here on ETNow. I'm Ajaya Sharma. The markets are maintaining the gains, part of the gap up, hovering above the 17,200 mark at the benchmark. Broader markets are quite nicely active, I would say. They're not bleeding off. At least there is attempt. This is also expiry week, so brace in for some volatility. Though global volatility index as well as Indian volatility index is come down quite smartly. And that's got to do with perhaps crude oil prices selling off. So that provides some cushion. Gaurav Dua is waiting for us to chat more about markets and fundamental factors in investing right now. Gaurav, afternoon. War is more or less in the price now, as they say in the market, Gaurav. But now the market is grappling with a new issue or new worry, which is lower growth and high inflation. How would that really play out in individual portfolios and equities as an asset class in your view in the next coming quarters?
Sure. So to give you a little bit of the background here, Ajay, you have had a 5 quarters of this earning upgrades. So there has been a very strong growth in earnings. This has been accompanied by the expansion in the multiples. Now, with this very high inflation input cost pressure, quarter 4 is likely to be the same quarter where you will actually start seeing the downgrade. Downgraded earning would mean that the multiples also in some part of the equity markets will come down. This basically means that market could remain range bound at best, or could see some stock specific volatile moves over the next few months. And it does not mean that there are no opportunities in the stock market to make money, but I think the investors will have to adjust and also this restructure their this investment portfolios.
Have you modeled your own portfolio? Or in fact, before that, the downgrade which you mentioned, what could be the extent of those downgrades for the full year? Will it really be very meaningful, or it will just be skimming the top?
So actually, if you look at it, some of the very heavyweights, for example, energy, banks, and also IT sector will not see any meaningful downgrades. I expect more downgrades in this building material side, basically tile company, pipe company, cement companies. There will also be some distinct downgrade in FMCG. There could be some distinct downgrades in this OMCs. So overall, I think the downgrades will not be big if you look at the EPS for Nifty. However, the fact is that after 4-5 quarters of regular upgrades, you're going to see some downgrades this time around.
Gaurav, how are you positioning your portfolio at your PMS? How are you, navigating through this high inflation issues, because that also impacts corporate earnings to a large extent?
So, when you have this kind of input cost pressure, what it will do is that it will impact these margins. Interest rates will go up. It will also increase your this interest cost. Also, consumer spending in some parts is going to go down. Okay, so to factor in all this, we believe there are certain spaces which are likely to do better in this kind of environment. IT is one. We believe IT has very strong distinct tailwinds, and it will not be affected by the input cost pressures. Pharmaceutical to an extent. Property stocks is another space where we believe that the demand is strong, and some of the larger players are able to take the distinct price hikes. Private sector banks are also a space which we believe will do well. So I think these are the spaces where you can increase your exposure. Apart from this, we also believe that because of this tough macro environment, small caps or the broader market stocks are going to struggle. They have had a very long, nice run for past year or so. We believe in 2022, the small caps are going to underperform. So this as an investor, you also need to bring down your exposure to this broader markets more towards towards this large caps and those players which have this pricing power.
How are you managing risk? How are you really, have you reduced risk in your portfolio, high beta? And what are your thoughts on volatility? Because FII flows have been very negative for several months now. Any signs or that they may ebb anytime soon?
So, as in terms of taking care of the risk, what I was just talking, we have brought down our exposure to small caps. We have brought down our exposure to those stock sector where we believe that they are going to struggle because of the high input cost. We have not, we have still kept the bigger this in picture in mind, which we believe that next 2 to 4 years, 4 years Indian economy is going to do well, and the corporate earnings will be healthy. So we have that in mind, but we are playing that more towards with our this increased exposure to large caps, and as I said, to spaces where we believe that they'll be relatively lower impacted by the high inflation.
Right. Gaurav, so if you could just give us a flavor, your current portfolio, which you've spoken about a little bit, what is the 1 year forward earnings outlook? What kind of earnings growth are you expecting blended of the stock that you hold at a portfolio level?
Sure. So we are looking at from FY22 to 24, the holdings that we have are likely to give us a 20 to 22% growth in earnings on a this thing compounded this thing basis. So we are still have our blend towards growth. It is not that we have shifted a lot from growth to say value, but yes, wherever we have exposure in mid cap, small cap, there we are taking extremely good care. We are trying to avoid those stocks which are expensive.
For example, just talking to JK Cement just today morning, and they were telling us that margins are going to be severely impacted. Similar commentary coming from others also because of high inflation. In your earnings growth estimate, what kind of margin reworking have you done because of elevated commodity prices, and how long do you think it can continue hitting in the earnings?
So as I said that this building material which is cement, pipes, tiles, and other companies, uh, along with FMCG are the two spaces where we believe that earnings downgrade will be highest, and accordingly our exposure to these spaces is extremely small. So because of that, overall what we have seen is that our estimates on a portfolio basis have come down by 2.5%, 3%, but it is not a very steep fall because we are not exposed to OMCs or to these kind of companies.
All right, Gaurav, we'll let you go on that one. Thanks so much for chatting with us today on your portfolio strategy. Time for a short break, more news-based analysis, stock-specific analysis on the other side. Don't go anywhere.